Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment podcast. My name is Jeb Graham, here with Ethan Hutchison and Eric Wymore. How are we doing today, guys?
Doing good.
Yep, doing wonderful.
Doing wonderful. Well, here it is. As this comes out, it's January. We're just coming off the holidays. We're actually recording this right before the holidays, and we were talking about our phones have been flooded this last month with people calling in wanting to give gifts to, whether it's kids, grandkids, nieces, nephews, John Smith, who washes somebody's car really well at the car wash, whatever it is. And we kind of started thinking that maybe just a full episode would make sense to talk about gifting, ways people gift, some rules around gifting, and some of the questions that we get around gifting. And I'll tell you the first question that I always get, and I'm sure for you guys, you've gotten it a few times too, is clients call in and say, hey, if I want to give my grandkid or my child $10,000, do they pay taxes on it or do I pay taxes on it? And the reality is neither of them pay taxes on it. And so we thought maybe starting out with kind of some rules around that, and then we'll go through the most popular ways that people gift to people, whether that's a UGMA, an education fund, or even more structured type gifting as well. But first, let's cover a little bit about high level kind of gift tax basics. Okay, so when people ask, do I pay taxes or does my child pay taxes when I give money to them? And we say that neither of them is, it's because we have what's called an annual gift tax exclusion. Okay, so for this year, which is 2026, which the exclusion's actually gone up this year, you can gift up to $19,000 per person per year without any gift tax reporting, meaning you don't even have to report it. So if you think about that, if you're a married couple, you can gift up to $38,000 per individual. Again, so if you have 3 kids and you're a married couple, you can gift each one of them $38,000 without any reporting. And then if you have, and you can do that with as many people as you want. So you could go to your kids, your grandkids, your nieces, your nephews, whatever it is. For wealthy people, very, very great way to get money out of their estate so that they don't have to someday pay estate taxes, or at least it mitigates some of the estate taxes they have to pay. Well, when do you actually have to file or report a gift to somebody? Well, you would have to do that if you gift over $19,000 to an individual per person, meaning if you're a married couple that gave $50,000 to somebody, well, you're then going to have to file or report the $12,000 that's over that exclusion. Now, what I'll tell you is even though you report that doesn't necessarily mean that there's any tax liability on it. And I'm not going to go in depth with this, but I'm going to kind of talk a little bit about the estate tax and the gift tax, how they go hand in hand. We've talked about the estate tax. Gift tax is kind of the same thing, or the gift tax exemption is that an individual currently has a lifetime exemption of $15 million. And a married couple has an exemption of $30 million. So even if you go over the annual exclusion, that just means it counts toward your lifetime exclusion, but you would have to give away $30 million as a married couple to actually have to start paying gift taxes, okay? However, that does reduce your estate tax exclusion. So meaning everything you gift in your lifetime that goes against that gift tax exclusion will also go against that estate tax exclusion. So you really can only give away $30 million total. Doesn't apply to that many people out there, right? But there are some that it does. But then the other question we get a lot is, okay, who pays taxes on it? And then the other one is, how do I do it, right? So do I just set up an account for them? Do I do this or that? But I think, the 3 most common are probably going to be what we call UGMA, UTMAs. Ethan's going to go over those here in a minute. And then, there's the famous 529 plan, which is education funding, which is a very, very, very common way that people do give money to people, and Eric's going to cover that. And then we're going to go over maybe some more structured gifting methods. But let's talk a little bit about the accounts, Ethan.
Yeah, absolutely. So like Jeb mentioned, UTMAs and UGMAs, and I'll also, towards the tail end of my little segment here, I'll discuss Trump accounts, which are fairly new. They're actually not even eligible to be opened right now, so there's a lot of legislation that just came into place, so we'll talk about that here in a moment. UTMA, UGMA, so UTMA is Uniform Transfer to Minors Act, and the UGMA is Uniform Gifts to Minors Act. Essentially, they're kind of the same account. There's a very, very little differences, and we won't even go into the differences because they're very seldom. So what is a UTMA account? It's an investment account. It's a taxable account that the child owns the assets for. So let's say in a hypothetical world, I am gifting my children money and I put it into that UTMA account. I might gift them $10,000 a year. We put it in that account and it gets invested. Over time, that's going to grow. You're going to keep funding that account consistently, and you might have $100,000, $200,000 in there by the time that child turns 18 or 21. And depending on your state that you live in, that is the year, it's called the age of majority, that child then gets all of that money. So I'm going to say that again, at 18 or 21, whatever's in that account without proper planning, that child receives 100, 200,000, whatever's in the account. It's the child's assets at that point in time.
With no restrictions.
No
right?
restrictions.
They can do whatever they want.
Yeah.
Buy a Lamborghini. If you want to go buy a Lamborghini, you can do it. Right?
Take a gap year and go to Burning Man, whatever it is. They can get out of the house and use that money. It's theirs, which is the biggest con or pitfall with the UTMAs. Now, there's things you can do around that. We had a pretty good conversation yesterday talking about just clients in the past that have, we won't get into it today, but they open up trusts and things of that nature. And there's some things you can do to prevent that windfall. But at the end of the day, I made the joke, if I was 18 and I got $250,000, I might not be sitting in front of this webcam right now. My life could have gone a different direction. It's a lot for the children to kind of understand. And when you're 18 or 21, you might not have a good relationship with money, and it can be very detrimental just to your career, I would say. So something to be aware of. Doesn't mean you should shy away from them. It's just, it requires a lot of education with the child and things of that nature. What can you use the money for? Very, very loose rules against what you can use the money for. Once the child turns age of majority, it can be literally anything. They can go buy a Yeti cooler, or they can go buy a house, or to Jeb's a Lamborghini, to Jeb's point. Hopefully there's not that much in there, but it'd be nice to have. So, and at the same time, there's taxes and things to be aware of as far as kiddie tax goes, and who pays the tax on the gains and the capital gains distributions and things like that in the account. But something else that you really got to be aware of is, I had it. You're going to have to edit that out. I was going for it. Yes. Something else that we need to be aware of and make sure that our clients understand is the downside of filing for FAFSA or federal student aid when it comes to how that UTMA is calculated in that overall calculation. So the UTMA is actually part of that child's assets. And so when you go to fill out your FAFSA form, whatever's in that UTMA account counts against the child as far as qualifying for student aid goes. So something to be aware of. If student aid and FAFSA is part of your family's future, you really want to be hesitant or just understand how those UTMAs affect FAFSA and student aid filing. The last one we'll talk about, which it's very, very new. It actually, I guess, the One Big Beautiful Bill is when that got introduced. Is that correct, fellas? I think so. It wasn't Secure Act, but it was the One Big Beautiful Bill, is the Trump accounts. Those will probably be renamed later, but as of now, you can go to trumpaccounts.org or .gov, trumpaccounts.gov, and kind of read all about these things. So the current president and his team enacted the Trump account law, these are accounts that are for children born between January 1st of 2025 and on. If they're born between January 1st of 2025 and December 31st of 2028, the government is going to gift $1,000 to those accounts if you open them. So just like your employer match, you'd be dumb not to just, make a contribution up to your match. Just go ahead and apply for these accounts. You'll get $1,000 for your children if they were born between January 1st, 2025 and on. The $1,000 contribution only falls between January 1st and December 31st, 28. So what are they? They are essentially qualified accounts that the child owns. They are tax deferred, so they grow tax free. The max you can put in these accounts is $5,000 per year. Your employer can contribute $2,500 per year into the accounts. However, that goes against the $5,000 max, so you'd only be eligible for $2,500. Who can contribute to these? Anybody. Grandparents, babysitters, colleagues, anyone can make a contribution on the child's behalf into that account. We've also got a lot of questions on how do I sign up for these? What do I do? There's a particular form that needs to be filled out. It's called Form 4547. You fill it out at the Treasury website and you establish that account. You can do that in June of 2026, and you can begin funding those accounts in July of 2026. Another big question is, where's the money held at? Well, initially, when you open the account, it is held at the Treasury level. And then over time, companies like LPL Financial, Fidelity, Schwab, those big custodians, they will slowly adapt to the Trump accounts. And you can then do a trustee to trustee rollover and transfer those accounts so that someone like us or your advisor can manage those assets. So the long and the short of it, the Trump accounts are for the child. Once they turn 18, they technically go into an IRA state, and they are taxed at an IRA level. So if you withdraw the money, it's income tax and early withdrawal penalties, etc. So when the child turns 18, it becomes their account, but it's their IRA, and then they can start making contributions based on their earned income. That was a lot. I'm sorry.
No, that's good. Well, there's been a lot of questions around those Trump accounts, and to be honest, us doing this podcast got us educated on them as well, because we have to educate ourselves. This podcast is a good way to do it sometimes. So,
right.
Absolutely. Which is good. So
if that's interests you, reach out to us on a one-to-one basis, and we'll kind of sit down and go over all the inner workings of those. But they're a great benefit. And again, if you have a child that's 1 year old or 6 months old, and you've got $1,000 waiting on you. So something nice to put in there for them.
Absolutely. Yeah. I'm glad I got to do 529s this podcast.
Yeah.
So let's talk about 529s, right? 529 college savings plan. Obviously, they've been around for a little while, probably pretty familiar. Our listeners are probably pretty familiar with what they are. But basically, what you're able to do is establish an account as an owner, the account owner. You're able to make contributions to this account. Those contributions, most likely will be deductible on the state income tax level, not the federal, but the state. All of that, those dollars that you contribute can be invested in different types of investments, mostly mutual funds or with a mutual fund family. All of the growth of those investments or those contributions are tax deferred. And then when it's time to withdraw, and if those withdrawals are used for qualified education expenses, those withdrawals are tax-free. So quite the advantage. So let's kind of break that down a little bit more. So let's talk qualified education expenses. Realize, first and foremost, it's college costs, college and university costs. That's room and board, that's tuition, books, supplies, other fees that you have that are involved with your college or university. Recently, it's also been added that you can use withdrawal to pay for K through 12 tuition. So up to $10,000 per year per student, you can use 529 money to pay for your tuition. You can also use the withdrawals can be used for obviously graduate or professional schools. So if you have a beneficiary that wants to go on to become a doctor, a veterinarian, business, lawyer, whatever, those expenses can be used or be covered with a 529 withdrawal. Another one thing that's new, $10,000 for the lifetime can be used to pay down student loan debt. So if you did graduate with some student loan debt and you still have some money in a 529, you can use up to $10,000 to pay off that student loan debt. Another thing, this is pretty popular. There is a DOL approved list, but popular because apprenticeships or trade professions are becoming more and more popular. They can actually use some of the 529 money to pay for those apprenticeship programs, which is pretty cool. As I mentioned, the investment options, you as the account owner get to select the investment options. And typically, our recommendation and kind of what the easy way put it on autopilot is just to do the age-based portfolios, right? So when you're younger, when the beneficiary is 0 to 5 years old, let's say, it's going to be in the more aggressive portfolio. There's different, portfolios within that aggressive growth portfolio, but they're going to be a little bit more aggressive. And then as the beneficiary ages, that portfolio is automatically going to become a little bit more conservative. So by the time they're 16, 17, 18 years old and getting ready to withdraw the funds to pay for college, they're going to be the most conservative and have the least, it won't avoid all market risk, but it's going to have the least amount of market risk. There's a lot of flexibility when it comes to contributions. Technically, there's really no annual IRS contribution limit. However, there's obviously there's gift tax issues that come into play with a 529. And believe it or not, they also limit it they cap the amount in a 529. And it's kind of on a different, each state has their own cap on what a 529 can grow to. So it's not something that can necessarily grow forever. Those account balance caps might be $300,000 to $500,000, but there is usually a cap on what a 529 can grow to, and that's dependent on the state. But they do have a special rule for contributions. It's called the 5-year gift averaging. So Jeb mentioned that the annual gift is $19,000. What $19,000 per year? What a 529 will allow you to do is actually combine those, or take it 19,000 times 5 and actually give that in a one year lump sum contribution to a 529. So you could dump $95,000 into a 529 plan when the baby's born and not have any issues with gift tax. Now, again, you can't make any contributions for 5 years, but that's the least way to fund or
see. We would probably say is you might want to run some numbers as to what that would actually be worth when the kid's 18 years old. Because to your point, like when you're running into limitations as to what that can be worth, that'd be a pretty expensive college education they were getting at that point, right?
Button up against those account balance caps. That's for sure.
That's right. Yeah.
You'd need to find the state that has the $500,000.
Yeah.
So again, I mentioned you're the account owner, right? You're the account owner. You get to control the account, the investments. You get to control the withdrawals, and you also get to control the beneficiaries. So you can change the beneficiaries. So if you have a couple of children and each have a 529 plan, and one, children, your oldest goes off and has academic scholarships or whatever, and your youngest decides to go to on to medical school and have extra classes, and there's money left over in your older child's 529 plan, you can change the beneficiaries of that account to your younger one and help them fund their college expenses. You can also change it to a grandchild. You can change it to a sibling. You can use it for yourself. You can change it to yourself if you want. So a lot of options on who the beneficiary ultimately is. And the last thing and I think this is kind of the highlight for what has changed recently in a 529 that maybe a lot of people don't know about, but the Secure Act 2.0 added a feature where you are able to roll over money from your 529 into a Roth IRA for the beneficiary. Obviously, there's caveats, right? But you are actually able to take up to $35,000 in a lifetime and roll that from your 529 into a Roth IRA for the beneficiary. A couple things that got to be met, right? So that account has to be opened, the 529 account has to be open for at least 15 years. So you can't just, when they turn 18, dump $35,000 into the 529 and immediately roll it into a Roth. That's not allowed. The 529 has to be open for at least 15 years. There's annual rollover limit. They're limited to the Roth IRA contribution limit. So 2026, that amount is $7,500. So you could take $7,500 from your 529 and roll that into a Roth IRA for the beneficiary this year. And then next year, do the same thing until you hit $35,000. And then the final thing is, The beneficiary must have earned income. So they need to be working. They need to have a W-2 or, have a job and at least earn up to the Roth contribution limit in order to be able to do that. So for 2026, they would need to make at least $7,500 in order to be able to roll it over. But a unique strategy. It's definitely, eliminates some of that fear of overfunding to 529. That some parents and grandparents have. And so it's a good option.
Definitely. So, and that I know that was always the biggest thing with 529s is that you don't want to overfund them because then you have to pay taxes on when you get it out, or you got to find another beneficiary to change it to. So that is a good option, but it is pretty limited at what you can take out of there, but it is definitely nice that you have something there. So, and I'll tell you, so those are two between the UTMA, UGMA, and your 529. I would say those are two probably of the most common ways that people gift money. But the last thing we want to cover, and we're not going to spend a ton of time on it, but we want to talk about what they would call gifting with structure, right? And that's more of setting up a trust. And I just to give you a little background as to why that is over time, and Ethan hit on this a little bit earlier. Where the 520, well, I guess Eric talked about the 529, where the 529 comes in is that money is used for a purpose. It's there for a purpose. So people don't worry as much about that. But when you talk about where Ethan was going with that UTMA, UGMA, is that I think a thing that happens a lot with people is they have a younger child, they start gifting to them, and they feel like them turning 18 or 21 is forever from now, right? And that it's not that big of a deal. And then what happens is you wake up and all of a sudden the child's 15 years old and you've got 150, 200, 300, whatever it is in this account. And then you have this kind of coming to Jesus moment of, oh my goodness, now my kid's going to get $300,000 when they're 18 or 21 years old. Not that even if your kid's a responsible kid, you just might not have a comfort level with that, right? And so, and you want to have at least some sort of control or stipulation on that. A great way to do this in another way is just to set up a simple revocable trust, right? And to do that, what you do when you set up a trust is number one is you would name the child as the beneficiary. It's going to be managed by a trustee, and then you're going to be the grantor. Whether you grant this to your grandchild, your nieces, nephews, your kids, whatever it is, you grant money to this trust. You can retain yourself as a trustee, meaning now you get to kind of control how it's invested and how the withdrawals are made. And typically what's going to happen is that when people take it out, they're going to put in trust provisions, right? And it can be several different ways that people do it, but the two most common are going to be age-based distributions. So you can set up this trust, you can become the trustee, child's a beneficiary, and then maybe, let's just say, hypothetically, they're allowed to take out 25% of the trust when they are 25 years old, another 25 when they're 30, another 25 when they're 35, so on and so forth. However you want to structure that, you can put in those age-based distributions. And then the other thing, the other more common is what are called purpose-based distributions. Okay, that could be like, hey, we're going to put this in. My kid can take money out for their education. They can take money out for housing. They can take money out to buy a car within certain limitations or whatever it is. And then you as the trustee can actually just put in there that they can take money out for reasonable reasons, and you just have to approve it as the trustee. And I think what that does is a couple of things. Number one, I'd say where kids are probably going to be the most vulnerable is going to be in their 20s, right? When they're graduating college, they're going to get a job, getting a big windfall of money can hinder that or delay that process. And then number two is you may have a child that's very responsible, but you don't know who they're going to run around with, marry, all that sort of things that could influence how that money's spent. And it just gives you that ability to have a little bit more control. The downside of this is number one is you do have a little bit more cost involved, and there's a little more complexity. And, obviously sometimes it can cause tension between a parent and child. However, I think it's just a good thing to keep in mind. And now lastly, if you are someone that set up a UTMA and you got to the, oh my goodness stage of this kid's almost 21 and now they've got $200,000 and I don't want them to be able to do this. A lot of times you can solve that just by a conversation, because technically you can't take that money and put it in a trust without the child's agreeing to it, right? So when they turn 18 or 21, whatever that age of majority is, it can be a simple conversation and just say, hey, this is your money, but we're going to put it in this trust, and there are more gifts coming. And in order for these gifts to come, you're going to need to put this money in a trust, and then basically just have that conversation. And I think as long as they're agreeable to that, then you can kind of change the course at that point once they hit that age of majority. So, but those are all, I think great ways, whether you're going down the road of UGMA, UTMA, these Trump accounts are going to make things easy, and then education and 529, or if you want to become a little bit more complex and do a full trust. And I would say if you're going to do that, the earlier the better, right? With the child, so that you don't get it to a point where you have a huge lump sum into an account that you don't want it to have what it has. So, but this has been a productive conversation, and hopefully for anyone that's listening to this, 2026 is a new year, and it might be toward the holidays this year when you actually start thinking about that, or sometimes people do it throughout the year. But I think this is a good rule of thumb when it comes to gifting. So anything else?
No, I think that's great.
Yeah,
absolutely. Top of mind, just
Top
had the
of mind,
conversations and about it over Christmas and the other holidays, and you're just ready to do something about it. Now's a great time.
I'm going to call my dad after this and ask him where my UTMA's at. He didn't.
What's that?
I'm going to call my dad after this and ask where my UTMA's at.
That's right. Where is that thing? Hey, I've had access to this thing for 15 years. Where's it at?
Yeah. USPS got a hold of it. It's lost.
That's right.
Yeah.
Well, very good. Well, this has been a productive half hour or so. And this is Metcalf Money Moment podcast signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.